So, very good morning. So, we continue with our topic. Our first topic was transitional partnership. And we have defined partnership. We have looked at the statement of accounting profit or loss and the differences between the profit required for accounting purposes and that required for tax purposes. So we looked at four differences. If you recall, the first difference was expenditure items, which have been taken through the income statement for accounting purposes, which are not allowable for tax purposes. And we give examples of such expenses like depreciation, like write-off of assets, impairment, general provision for bad debts, taxes, stamp duty, and other taxes. So those expenditure items normally are added back to the reported profit in adjusting the profit for tax purposes. Then there was a second difference. We talked about specified sources of income. So in accounting, income is just put together as income. However, for tax purposes, income must be categorized according to specified sources. So specified sources of income include employment, business income, farming income, rental income, investment income. Now, each of those sources have specific provisions or regulations on how the incomes are taxed. So for tax purposes, specified sources of income have to be deducted from the reported profit and calculated separately or treated according to the specific provisions and not simply put together the way it is in accounting statements. Just as an example, rental income has provisions. So rental income currently in the Finance Act 2023-2024 of up to 15 million shillings, the rate of tax is 7.5% per month. Now that's under monthly rental income tax regime. Those are very specific provisions. So you cannot just add them to the other incomes. So those landlords who wish to opt the standard regime. The standard regime is annual. The standard tax, income tax regime, where you accumulate rental income for the whole year, then you can deduct the allowable expenses incurred so that whatever else is left as net income is taxable. If it's a company at corporation tax rate at the end of the year, if it's an individual, then of course you use the graduated scale rates. Same to farming income. You can either use presumptive tax rates of 20% of the source. Alternatively, if it's not subject to presumptive tax, it can still be added to the other incomes and taxed. Then you have investment income like dividends and interest. Dividend is subject to withholding tax. We saw that there's a rate of 5% on dividend from a company. The 5% is remitted to the Revenue Authority. For interest income from treasury bills and bonds, from fixed deposits, the withholding tax is 15%, again remitted to the Revenue Authority. So that's specified sources of income. So what's the adjustment for specified sources of income? We deduct the specified sources of income and calculate them separately. In case of loss, for example, from farming, that loss must be carried forward and will not be offset against the other incomes available for business. So losses are carried forward and can only be offset or set off from the same source that generated the loss. In other words, from farming. In the future years, next year, the subsequent year, you can carry forward the losses that way. Then there was a third difference between the reported profit for accounting purposes and the profit required for tax purposes. Now, the third difference was capital expenditure. So when you go through the statement of reported profit for accounting purposes, you could come across cost of buying computers, cost of partitions, furniture and fittings, computer software, motor vehicles, signboards, billboards, etc. So these are capital expenditure items which are not allowable as expenses for tax purposes. So the correction when you are adjusting the profit for tax purposes is to add back each of these capital expenditure items. In addition, for tax purposes, we'll grant investment allowances. So investment allowances are tax incentives which are granted for two reasons, which we saw. One reason why we grant investment allowances is as an incentive to motivate, to encourage investment in any area of business in this country. The other reason is to compensate for the loss in value of an asset that is being continually used. So an asset that is being used continually will lose value. So we grant investment allowances as a form of compensation for the loss in value of an asset that is used continuously in generating profit. So that's capital expenditure. The fourth reason, probably, we said we are only going to discuss 4 reasons why there's a difference between the reported profit and for accounting purposes and the profit required for tax purposes is the reported profit could include or normally includes non-taxable incomes. So there are incomes which are included as part of accounting profit, which invariably are not subject to taxation. An example would be unrealized foreign exchange gains. So these are foreign exchange gains which are recognized for accounting purposes because of changes in the exchange rate, but the transaction has not yet been effected. Because the transaction is not yet completed or effected, the gains have not been received, have not been realized. So any income that has not been received is not taxable. So in that sense, non-taxable incomes like unrealized foreign exchange gains, interest on cash drawings by partners, or gains from foreign investments will simply be deducted from the reported profit. So with those 4 points in mind, we came up with a format, a general format, which we use for adjustment of the accounting profits or loss. So I'll just recap this format. So statement of adjustment, tax and profit or loss. So this is the format we looked at. So you say you pick the reported profit. With that, then you say add back. So you add back the disallowed expenses. Add back disallowed expenses. You also add back capital expenditure. Back. Then you deduct specified sources of income. we deduct non-taxable income. Then you deduct investment allowances. The thought of that is what we call adjustment. Okay, so that is now profit for tax purposes. And then we did look at our definition of partnership, and we said a partnership, according to the Partnership Act, Cap 29, is a relation that subsists between persons carrying on a business in common with a view to profit. And we said a partnership, the profit of a partnership is deemed to be that of the partners because the business is not a legal entity. So even though we already have a profit here for tax purposes, the partnership is deemed to be non-existent. The business is merely a relation between persons with a view of profit. So the motive of the partnership is to share this profit. So that leads us to the next step. This profit must be shared. So they looked at the distribution scheme. So here we did allocation. Then we made an assumption that let's suppose in a simple hypothetical situation that we have two partners. We have partner A and partner B, and the last column is called total. So we have those partners. That shillings. Before we look at shillings, also assume that the partners, we also assume in our illustration that the partners share profits and losses equally. So half, 1/2, half, they share equally. Then you do what we call allocation. You allocate to the partners any payments that they had received. So they had received interest on capital. So interest on capital is allocated. So interest on capital with the partner, then you add the total. Then we have salaries. We said assume that only B got salaries. So salaries for B, and the total is that. Then we have interest on capital. So interest on drawings. And we assume that the only person who makes drawings, cash drawings, is A. So we deduct interest on drawings is the deduction. And the rest will be share profit or loss. Share of profit or loss. So we said this one has to be computed. So we took this adjusted profit here and we drew a double line. The adjusted profit drew a double line. Then we said put the adjusted profit in your calculator. Okay, you put the adjusted profit in your calculator, then subtract the total column items minus interest on capital minus salaries plus interest on drawings. What you arrived at is excess. A gets half, B gets half. Then you get the subtotals of each. That's the subtotal of A, subtotal of B. If you add these two, you should still get the adjusted profit. So that's how you verify whether you are right. Adding downwards or across, you should still get the same. Then we said there were other specified sources of income. For example, if the partnership was also engaging in farming, so farming income, A gets a share of farming income, B gets a share. You don't put the total column, and then you do dividends. And you said this is a very specific dividend from farmers' cooperative societies. A gets his share, B gets his share, then you get the total. So this is the taxable income for A and B. And you call this the total taxable income. So A is that, B is that. So that is where we had reached in the other class. We said that's how you prepare the two statements. So your examiner, in his requirement, will require that you prepare a statement of adjusted profit or loss, then you distribute that to the partners for the simple reason that the business is not a legal entity. So the partners who are going to pay tax using the individual graduated scale rates based on the total taxable income. So in this class, we did mention we will introduce admission of a partner and retirement and how we are going to deal with admission and retirement. So we will assume, okay, first of all, when a partner is admitted or retired, our objective here, okay, our objective is to ensure equity, that a partner only gets a share of profit for the period he was present. A partner does not benefit on any income accruing after he has already retired or before he joined the business. That is the principle. That's the principle here. And to help us with this principle, your examiner will always tell you, that revenues and expenses assume they accrued equally throughout the year. So that will allow you to make a distribution or to allocate, to apportion. You do apportionment based on the dates. There are two likely approaches to apportionment. The first apportionment A will be where all revenues and expenses accrue equally during the year. If all revenues and expenses accrue equally during the year, then you don't need to apportion the income statement. You will adjust the way we've adjusted in our early example, but the apportionment will come. The apportionment will come in the distribution schedule. If all incomes and expenses accrue equally during the year. However, if there is one or two expenses that only occurred after admission or before admission, then that expense must be apportioned in the correct period. So that means, for example, if assets were acquired after a partner had already been admitted, then the investment allowances expense will be charged in the period after admission, right? So there are only two ways, okay? So moving this side, we want to discuss something about admission. So we say admission or retirement. And probably we can make a few points and say a partner may be admitted. On time. Also the year. The objective is to share profit equitably. So the objective is to share profit accruing before and after admission, retirement. Equitably yeah. Then you say in case income and expenditure accrued evenly in case income and expenditure accrued evenly throughout the year. For the year, the adjustment for admission or retirement partner shall be effected through the distribution schedule, or only shall be effected only in the distribution schedule. By apportionment. So in case income and expenditure, according to the examiner, are accrued equally throughout the year, all income and expenditure, then the adjustment for admission or retirement of a partner shall be effected only in the distribution schedule by apportionment of incomes. You will not need to adjust the income statement. However, if any expenditure was incurred specifically in a specific period, e.g., pre-admission or retirement, or post admission or retirement. And both the income statement both the income statement and the distribution schedule will be adjusted. Adjusted by apportionment. Of the income. An example of this second case is where assets were acquired specifically in a period before admission or after, and you have to claim investment allowances. That investment allowance must be charged on the specific period. So it means you have to have columns. You have to prepare an income statement in column form. For example, January to June and July to December. Then you charge the investment allowance in the specific period where the assets were acquired for purposes of the business. Then even the distribution schedule will likewise be adjusted. So that's the treatment. That's the treatment we are going to give to the income statement of the distribution schedule, depending on, for admission or retirement of a partner, depending on the circumstances in the question. So if all the revenues and expenses accrued evenly, so they accrue equally throughout the year, then there is no need to adjust the income statement. You make your adjustment for the distribution schedule, as we have not shown an example yet, but you will split the incomes. For example, interest on capital will be split between the period before and after admission, salaries before and after admission, and so on and so forth. So you only adjust the distribution schedule if everything accrued equally. But in case there is one expense that did not accrue equally, then you must charge that expense to the correct period in the income statement. So you'll have the income statement split into columns and you charge it into the correct period. So this can only be explained later, and we'll do that using a class illustration. So for now, we'll just take this and try to understand as much as we can until when we look at our first illustration. Actually, our first illustration will be on admission. Okay, but we'll try also to get an illustration for this case B, where the expenses did not accrue equally, so that we adjust both the income statement and the distribution. And case A, where income and revenues accrued equally, where we only adjust the distribution sheet. We look at both. We look at both examples. So at this point, we want to quickly look at something different. We want to go into looking at details of what are these allowable and disallowable expenses. So once we've done that, then we'll be able to take our first class illustration. Though in the meantime, I think I can even give that illustration as I can give this illustration as an assignment question, because now we've completed all aspects of partnership. So as I move to allowable and disallowable expenses, let me give my first assignment question. So assignment. This would be my past assignment question to the class. So you can try December 2014, December 2014. December 2014, question 1. So December 2014, question 1. December 2014, question 1 is called BP Enterprises. BP Enterprises. So that question will illustrate admission of a partner. December 2014, question 1. So you try that illustration. In the meantime, I will look at details of what is allowable expense and what is disallowable expense. So our next discussion is allowable and disallowable expenses. So allowable and disallowable expenses. Allowable and disallowable expenses. So we'll start with allowable expenses. So this is under section 15. So section 15 of the Income Tax, ITA is Income Tax Act. Section 15 of the Income Tax Act, we call this allowable expenses. So section 15 of the Income Tax Act is called allowable expenses. These are allowable expenses from tax point of view. Section 15 of the Income Tax Act, allowable expenses. So section 15 of the Income Tax Act has a list of what we would refer to generally as allowable expenses. So the list is not an end in itself, but it will give you some principles or guides that will help us in determining other. So consider these as principles, as a principles or basic guides that will help us determine anytime there's a question of what is allowable and what is not allowable, then we shall refer to these principles. Okay? So section 15 of the Income Tax Act generally allows expenses. So section 15 of the Income Tax Act generally allows expenses. Expenses that are, now this phrase is very important, I will quote it, expenses that are wholly and exclusively incurred. Wholly and exclusively incurred. Wholly and exclusively incurred to generate or in the production of profit. In the production of profit. In the production of profit. End of quote. So expenses that are wholly and exclusively incurred in the production of profit. Now, this point is a principle that can be a guide to us in so many areas. For example, in so many areas. For example, I can ask myself, look at the question of rent. I can look at rent in the light of this principle, yeah? Rent. So if I put rent here and I ask, is rent wholly and exclusively incurred to produce profit? The answer is yes. Yes, because without paying rent for the premises, you cannot produce profit. In the same way, an expense like electricity, salaries and wages for the workers. Okay? So generally, tax will allow expenses that are wholly or directly incurred in production of income. Okay, so these are usually normal trading expenses or business expenses. Examples of such business expenses could be salaries and wages. You cannot run business without salaries and wages. Payment of salaries and wages expenses, payment for purchases of goods, payment for transport, I mentioned rent, electricity, water, and so on. All right? Now, there are certain expenses that will fail these tests. An example of an expense that will fail that test is depreciation or even taxes. I do not need to pay taxes to generate profit. So taxes are paid after profit has already been generated. So taxes are not expenses that are wholly and exclusively incurred to generate profit. So when determining the expenses that are wholly and exclusively incurred in the production of income, the nature of the business must be considered. So expenses are not entirely or exactly the same. Expenses incurred in a farming business may be very different or slightly different from expenses incurred in farming, for example. So the nature of the business will be considered because they differ from business to business. Now, we can list the expenses under Section 15 of the Income Tax Act, which are considered to be wholly and exclusively incurred in the production of income. And the first expense would be the amount of trade and bad debts written off. So number one, you say the amount of trade and bad debts written off, and bad debts written off. The amount of trade and bad debts written off. That's our first expense under Section 15 of the Income Tax Act. Please note, we are saying trade bad debts. And we'll give an example. For example, if the business had sold an asset Probably they sold a car, or the business has sold, an asset, a car, furniture and fittings, computers. They've sold. Then the debtor fails to pay. Now, that is not a trading bad debts, because the business does not trade in furniture, the business does not trade in computers, the business may not be trading in motor vehicles. So trading bad debts, amount of trade bad debts, suggests business stock, the stock in trade of the business. What does the business trade in? So that has to be the amount we write off. Another example, if the company gives loans to employees and the employees fail to pay, that is not a business bad debt unless the company is a bank, which normally deals in loans, but an ordinary company giving loans cannot write off that as a bad debt in the income statement, for the simple reason that will not be a trading bad debts. So our first allowable expense is the amount of trade and bad debts written off. Now, the emphasis here is on trade. So the bad debts must result from the trade, otherwise the bad debts will not be allowed. Then we go to number 2. Number 2 is specific provision. Specific provisions for doubtful. Specific provisions for doubtful and bad trade debts. Specific provision for doubtful and bad trade debts. Specific provision for doubtful and bad trade debts. Now, what does this mean? There's a difference between a general provision and a specific provision. Now, we're talking about a specific provision. Specific provision means one of our debtors, a particular debtor, has been declared bankrupt. Probably we had sold goods to this debtor amounting to 300,000 shillings, just as an example, and we have information, okay? We even have documentary proof that this debtor is now bankrupt. So it means 300,000 must be written off because it will not be recovered, because the debtor has been put under receivership. Now, that's called a specific, that's a specific provision for bad debts. That's a specific provision for bad debts. Now, that would be very different from what they do in accounting. So in accounting, if the amount of debtors by the end of the year, total debtors is 200,000, and you make a provision of 20% of that, and you say, from our business experience, 20% of debtors normally don't pay. So if 40,000 is charged in the income statement, that would be a general provision. Why do we call it a general provision? Because we do not know the exact amount that will be written off. So if we knew, for example, how much out of the 200,000 was not paid, then that would be specific. But I cannot say I'll make a provision for 20% of 200,000 and charge 40,000 in the income statement. That would be a general provision. So a specific provision means a debt has been declared bankrupt, or I know of a particular debtor, probably for one reason or another, I know they'll not be able to pay. So I make this provision for this particular debtor, then that would be a specific provision. So that was number 2, specific provision for bad debts. Then number 3, any capital expenditure incurred for prevention of soil erosion in agricultural land. So we are looking at production in agriculture or farming business. So any capital expenditure for prevention of soil erosion in agricultural land. So we could have businesses that are purely commercial farming activities. So prevention of soil erosion means the commercial farming. In commercial farming, the farm has incurred expense in construction of a gabion. You know, a gabion is a structure. You put wire mesh and you put, a lot of rocks, big rocks, to hold soil so that it doesn't pass. So the whole thing is capital expenditure. But since it's for prevention of soil erosion, for any business engaged in, agricultural production, it is allowed as an expense. Then number 4, capital expenditure incurred. Capital expenditure incurred on clearing land and planting permanent or semi-permanent crops. And we have examples of such crops. Capital expenditure incurred on clearing land and planting permanent or semi-permanent crops, such as sisal, coconuts, coffee, tea, bananas, rose flower, etc. In other words, you can charge an expense for clearing land in the income statement. But the condition is you cannot charge an expense for clearing land for crops that are harvested frequently. It must be permanent or semi-permanent. It means the crops will stay longer before the next clearing. And these are examples of crops that stay longer, like sisal, like coffee, tea. So a condition for allowing an expense for clearing of land would be the crops which are being planted. Are they permanent or semi-permanent? And permanency is depicted by how long before the next clearing. So it must take a while before claiming the next clearing of land, like coffee, like tea, like bananas, like coconuts, like sisal, cashew nuts, etc. Then number 5, pre-trading. Pre-trading expenses incurred before. Pre-trading expenses incurred before commencement of the business. Pre-trading expenses incurred before the commencement of the business, which would otherwise be allowed. Pre-trading expenses incurred before the commencement of the business, which would otherwise be allowable if the business were in operation. If the business were running, these expenses would be allowed. We'll give examples of those, like the cost of cultivating a farmland, or the cost of applying fertilizers before harvesting. That's pre-trading. Before harvesting the crop would be allowable in case of a farmer. Additionally, for a hotel business, the cost of training of staff, the cost of training of employees before operations of a hotel commence would be allowed. They are pre-trading, yes, but they would be allowed because these are normal business costs. So the cost of recruiting hotel workers, the cost of training of staff before commencement of a hotel business would be allowable expenses. Then number 6, we have legal expenses. So legal expenses that would be allowed, legal expenses. So the legal expenses that are specifically allowable include A, for preparation of a lease agreement which does not exceed 99 years. So leasing could be leasing of land, could be leasing of a building. So the legal cost for drafting a lease agreement would be allowable as long as the lease period does not exceed 99 years. So that's our first allowable legal expense, The next allowable legal expense, B, is for collection of trade bad debts. So the bad debts must be trading, collection of trade bad debts, like, e.g., the legal expenses for filing a suit, against a defaulting debtor. So if you have legal expenses for collection of bad debts, like filing a suit, against a defaulting debtor, then that would be allowed. Then C, for preparation of staff contracts when recruiting new employees. So legal cost in preparing staff contract when recruiting new employees is allowable expense. And D, legal expenses incurred in listing the shares of a company at the Nairobi Stock Exchange. So legal expenses incurred in listing the shares of a company at the Nairobi Stock Exchange, NSE, for the first time. So if shares are being listed for the very, very first time, the legal costs incurred for listing those shares will be allowed. So that was number 6. Legal expenses that are specifically allowable in as far as allowable expenses for tax purposes are concerned. Then you have number 7. The expenditure incurred, these are for landlords. The expenditure incurred on the structural alteration. The expenditure incurred on the structural alteration to the premises before letting. The expenditure incurred on the structural alteration to premises for letting. To premises for letting. To premises for letting, e.g., the cost of subdividing bigger or open rooms. The cost of subdividing open rooms in a property, which is being done to maintain the existing rent. In other words, the rent is not being increased. Now, this subdivision is just being made for purposes of facilitation of letting of the property. Probably you need more rooms for the occupants, or the structural alteration could be to include parking for the tenants, or include a facility that was not there. So even though it is capital expenditure, it will be allowed. However, there's a catch to that. There's a downside to it. If after subdivision of open rooms, or after the adjustments have been made to property, rent is increased, then it will be considered that what had been incurred was capital expenditure. So it becomes capital in nature, because if rent is increased, then it means the value of property has been enhanced. If you enhance the value of property, then that becomes capital expenditure. We will disallow that. We only allow expenditure that is revenue in nature, not capital. Then number 8, we have a cost called mortgage interest. So what is mortgage? So mortgage is a loan that is taken by individuals from a bank or a financial institution to acquire property which is owner-occupied, but there is a restriction. For the current mortgages, the maximum interest allowable per year is 300,000 shillings, or per month it is 25,000 shillings. So in case of a mortgage or a loan used to acquire owner-occupied property, you bought a house and you're fully occupying that property, the amount allowable as an expense against your income is 25,000 per month, or 300,000 shillings per year. Then number 9, donations. cash donations to charitable organizations or charitable institutions. So any company or individual making donations to charitable organizations, it shall be allowable deduction according to income tax regulations of 2007. So there are regulations to regulate the charitable donations, but the donations shall be treated as allowable expenses. The regulations are in the income tax regulations of 2007. Then this should be number 10. Number 10, diminution. Diminution, the word diminution refers to loss in value. So there is diminution or loss in value of loose tools. So we have diminution or loss in value of loose tools and implements. So we are talking about diminution, and this is 10. Diminution or loss in value of loose tools. So the rate of allowance that will be deducted for loose tools and implements here is 10%. 10% for each year on a reducing balance. So the question is, what are loose tools and implements? So loose tools and implements are items or capital expenditure that are not expected to have an economic value of more than 3 years. This is just an estimate. Estimated economic value of 3 years. Now, what would identify as loose tools and implements will vary from business to business. In a hotel business, what is considered to be to have a short economic life would be cutlery, cutlery, utensils in a hotel. They are susceptible to breakages. So they are not considered as items that can stay long. So we'll write off the cost at the rate of 10% per year on a reducing balance. In a workshop, okay? In a workshop for, say, like General Motors, a workshop for motor vehicles. Loose tools will be like spanners, screwdrivers, nuts and bolts, such. Again, you'll provide 10% on a reducing balance. In a farming business, loose tools will be things like spades, rakes, pangas, and so on. So that's what will be providing 10% per year on a reducing balance. Then number 11, the annual entrance and subscription fees. The annual entrance and subscription fees paid to a trade association. The annual entrance and subscription fees paid to a trade association, such as Kenya Association of Manufacturers, Kenya Chamber of Commerce and Industry. So what you pay as entrance is when you are joining, entrance fees. Subscription is what is paid every year in the subsequent years. So annual subscription fees paid to a trade association such as Kenya Chamber of Commerce and Industry, Kenya Association of Manufacturers, or Federation of Kenya Employers shall be allowed as an expense. So that is number 11. Then number 12, the expenditure incurred for scientific research, whether it is capital or revenue in nature. So businesses may have research costs. They may incur costs, probably to carry out research and have better products. I know Safaricom does that. So that's how they are able to be innovative, create new products. They not only have modified the M-Pesa platform, they've come up with very, very creative other products which generate income for them. So for you to produce new products or to innovate, expense will be incurred for research, for buying equipment, and even for the research itself. That expense is allowed. Then number 13 is related to that. The business of the company may itself not be engaged in directly in research, but may contribute to a research organization or to a university that carries out research related to the business they are doing. So the amount of contribution to a scientific research institution, the amount of contribution, that's number 13, the amount of contribution to a research institution approved by the commissioner and which undertakes research related to the class of business of the contributor. For example, EABL may make contributions to Kenya Agricultural Research Institute, KARI, and if KARI researches on barley or wheat products, KBL or EABL uses barley and wheat in production of beer. So the research is related. So that contribution to the research institute will be allowable as an expense. However, if BAT contributes to research in KEMRI, KEMRI is Kenya Medical Research Institute. Now, that research is not related to the business of BAT, so it will not be allowed. Number 14 is related to the other three. Now, this is contribution not to a research institute, but to an educational institution, research in a university. So the amount of contribution to a university or research institution approved by the Commissioner for Scientific Research, like University of Nairobi, okay, or AMREF. AMREF also carries out research, or Moi University, or Egerton University, or JKUAT. So JKUAT does a lot of research, especially agriculture related. So any contribution to research in a research institute or university recognized by the Commissioner for Research is allowable deduction. Then number 15, contribution by the employer on behalf of the employee to a registered pension scheme. So if the employer makes contributions on behalf of his employees to a registered pension scheme, then it's allowable as a deduction. That was number 15. Number 16, the expenditure on advertising. The expenditure on advertising to promote the sale of goods to promote the sale of goods by a business, e.g., advertisements on TV, on radio, or newspapers. However, advertisements that is capital in nature, like putting up billboards, putting up signboards, putting up neon signs will not be allowed because that's capital expenditure. But you can claim investment allowance on billboards, on signboards, on neon signs and lights at the rate of 10% per annum on a reducing balance. Then number 17, the amount of interest on money borrowed. The amount of interest on money borrowed and used in the production of income. The amount of interest on money borrowed and used in the production of income, e.g., interest on loans. The business has taken a loan from a bank. So interest on loans is allowable expense, or interest on overdrafts, bank overdrafts, or debentures. So loans borrowed by a corporate are referred to as debentures. So any interest on those is allowable. Then number 18, any amount of loss brought forward from the previous year, as long as the loss is offset or written off against the same source that generated the loss. So amount of loss brought forward from the previous accounting year would be allowable as long as the loss is brought forward against the same source that generated the loss. We had mentioned this concept, or we had mentioned this under specific provisions. Remember, specified sources provisions, specified sources provisions. So this is related. Any loss from a specified source will be carried forward and will be offset against profits from the same source that generated that loss in the future years. Then number 19, the amount of realized foreign exchange loss. The amount of realized foreign exchange loss means the exchange rate has been unfavorable. So the company, for example, had acquired stock of goods worth $1,000. And this stock of goods worth $1,000 was acquired in the month of July. So in August, the exchange rate becomes $1 in August is equals to, okay, let's start with July. So imports. Imports were valued at $1,000. Then in July, the exchange rate is $1, exchanges for 130. In August, the exchange rate now becomes 137. Then in September, when they are supposed to make payment, $1 exchanges for 142. Okay? Now, in July, what they owe for the imported goods is 130,000 Kenyan shillings. It's 130 times $1,000. So they owe 130,000 as a debt. Let's say the debt is supposed to have been cleared in September. In August, the accountant will recognize a loss because the debt is now swelling. The debt is now 137,000. But that is unrealized. It cannot be deducted because they've not paid anything. So they've not lost anything. So this is unrealized. But on September, they have a bigger loss. Now the debt has grown to 142,000. Okay, so there is 12,000 more they have to pay. Now that is called realized foreign exchange loss. That is allowed. Realized foreign exchange loss shall be allowed. You can charge that, but if it's unrealized, you will not allow that. So that was number 19. The last one should be number 20. Investment allowances. So investment allowances are granted on capital expenditure incurred. And the list of investment allowances are in the second schedule of the Income Tax Act. Examples of investment allowances are motor vehicle allowances at the rate of 25%, computer allowances at the rate of 25%, furniture and fitting allowances at the rate of 10%. So any of these investment allowances shall be allowable expenses. Probably I mentioned one more, number 20. The amount of trading loss of a business. The amount of trading loss of a business. The amount of trading loss. Of trading loss of a business. So the trading loss here refers to disposal of assets. So when you dispose all the assets of a particular category, say you dispose motor vehicles, and you dispose the motor vehicles at a value that is lower than the residual of the book value of the motor vehicle, that loss is called a trading loss. If the business is a going concern, trading losses are allowable expenses. If the business is under liquidation, the same loss will be referred to as balancing deduction. It's just a naming, a change in terminology, but the concept is the same. I am disposing assets, say computers. I have 3 computers. The net book value, for example, the total net book value of the computers is 140,000, 3 computers. But I've sold the computers at 90,000 shillings. So I've made a loss of 50,000 shillings. 50,000 shillings is a trading loss if the business is a going concern. The same loss of 50,000 will be called a balancing deduction if the business is under liquidation. The business is under receivership. Then you call that a balancing deduction. So that class is our list of allowable expenses. Remember, I've said this list cannot list everything, because that time you'll be talking about laws. So a law or a regulation. So with that, it will be very difficult to list every little item that is allowed. So we call them, principles, a group of principles or a bunch of guides. So these are guidelines, principle guidelines in considering what is allowed expense in a business. And you'll find them very, very useful. We'll be using these principle guidelines to guide us in determining expenses that are allowable in a business. Now we'll turn to the final lists, which is section 16 of the Income Tax Act. Now, this one has a list of principles again, which guide us as far as disallowed expenses are concerned. So we look at section 16 or section 16 of the Income Tax Act, ITA. We call this disallowed expenses. Disallowed expenses. Section 16, disallowed expenses. So what are disallowed expenses? So these these are expenses that are not wholly and exclusively incurred in the production of income. So they are the opposite of Section 15 of the Income Tax Act. So these are expenses that are not wholly and exclusively incurred in the production of income. Usually, the general approach in adjusting the statement for tax purposes is simply to add back these expenses. So when you are adjusting the reported profit for tax purposes, you will add back the disallowable expenses in adjusting the profit for tax purposes. So disallowable expenses included under Section 16 of the Income Tax Act include the following. Number one, the expenditure or capital loss in form of depreciation. So the expenditure or any capital loss in form of depreciation, amortization, loss on sale of assets, write-off of assets. So all these losses we are talking about are capital losses. They refer to losses incurred in relation to an asset. Okay? So expenditure or capital loss in form of depreciation refers to loss on an asset, impairment, writing off of assets, etc. All those we said will be disallowed. So capital losses will be disallowed. Instead, we will grant investment allowances for tax purposes. So that's number one. Number two, general provisions for bad debts. General provisions for bad debts, for example, if you make a provision of 20% of the total debtors. So if the total debtors at the end of the year amount to 200,000, and you take 20% of that, 40,000, and you charge in the income tax statement, for accounting purposes, it makes sense. But for tax purposes, we call that a general provision. So general provisions are not allowed. What we allow is specific. Debtor X owes the business 10,000 and debtor X has been declared bankrupt. If I provide the 10,000 in the income statement, that's a specific provision. But if I take 20% of all debtors, that's a general provision. Number three, any amount of personal expenditure. So if you incur an expense of a personal nature by an individual to maintain himself or to maintain his family, domestic expense, private expense, or for domestic purposes, like personal entertainment expenses, okay? School fees for children, personal traveling expenses, personal medical expenses for an individual paid for by the company will be disallowed. Even personal catering expenses. Unless if expenses are incurred of a personal nature while an individual is on a business trip, or during training of work-related conferences or business during training, then it will be allowed. Then number four, any pension contribution made by the employer to a pension scheme that is not registered. Unregistered pension scheme will be disallowed. Any pension contribution made by the employer to unregistered pension scheme will be disallowed. Then number five, there are legal expenses that are specifically not allowed. Legal expenses that are specifically not allowed include A, legal expenses incurred in purchasing personal property. like a house, personal property, like residential property. B, for preparing memorandum of association or a partnership deed or articles of association of a company during formation is not allowed. C, for preparing a trade agreement or a contract. D, in defense of criminal proceedings or charges. You've probably defaulted on a loan, or you've broken some traffic regulations. Any penalty charged for an offense committed shall not be allowed. So in defense of criminal charges or penalties or even proceedings are not allowable. Then E, for preparation of a lease agreement of more than 99 years. You said the maximum allowable is 99 years. Next, in relation to any appeal, any tax appeal. The tax appeal could be to the Income Tax Tribunal. It's called the Tax Appeals Tribunal. That's what it's called. The Tax Appeals Tribunal, or even to the court. The High Court, the Court of Appeal, the Supreme Court. Any cause of tax appeal will not be allowed expenses. So that's it for legal expenses. Then number 6, any amount of reserves or provisions made by a business, any reserves, except for specific provisions for bad debts. So any kind of reserve made by a business, any kind of provisions made by a business is not allowed. Number 7, any types of taxes paid, whether VAT, stamp duty, corporation tax, excise duty, are not allowed. Number 8, unrealized foreign exchange losses, whether these losses are capital in nature or revenue in nature, will not be allowable as long as they are unrealized. 9, the amount of expenditure or losses that are recoverable. Any expenditure or losses recoverable under an insurance contract. You've already insured or you've already been indemnified for those losses. You cannot charge in the income statement because you'll be profiting. You'll be claiming twice. So any amount of expenditure or losses that will be recoverable under an insurance contract or indemnity is not allowed. Then lastly, the amount of expenditure in the production of income by a non-resident person. So non-residents are not allowed to claim any expenses. Why? Because their incomes are taxable under very specific withholding tax rates. For example, if a non-resident has rental property, the withholding tax rate is 30% without deducting of expenses. If a non-resident person has income in form of royalty income from intangible property, withholding tax will be 20%. So any expenses incurred by a non-resident person will not be allowable for tax purposes. So that concludes our discussion on the segment allowable expenses under Section 15 of the Income Tax Act and disallowable expenses under Section 16 of the Income Tax Act. So, what I want to proceed to next, perhaps, is to discuss Part A of the assignment question had given called BD Enterprises. So I'll discuss part A and leave out part B for the class to attempt as an assignment. So I will move to this assignment question. So the assignment question is December 2014, question 1. A and B, we call it BD Enterprises. I will discuss part A of the question. Let's move to December 2014. The assignment question is December 2014. December 2014, question 1. Let me just get my past paper questions. So December 2014, question 1. A, Roman 1, explain the meaning of the term tax planning. And Roman 2, outline 4 reasons why enterprises engage in tax planning. So to answer this question, we refer to the Tax Procedures Act. So there is an act of parliament referred to as Tax Procedures Act of 2015. So the Tax Procedures Act will give us some details on what tax planning is. But briefly, I would say this. Tax planning is legal, compared to tax evasion. Evasion is a criminal offense under any tax law. If you are caught in tax evasion, then the penalties could be very, very severe. But tax planning refers to, taking advantage of the provisions in the income tax legislation to reduce the burden of tax without contravening. You don't break any law. So there is no contravention. So without contravening. Without contravening, without contravening any tax law or legislation. So we'll answer the first part. So part A, Roman 1, the answer is meaning. Meaning of the term. Meaning of the term, we call this tax planning. Meaning of the term tax planning. Meaning of the term tax planning. Probably you can write and say the Tax Procedures Act of 2015. The Tax Procedures Act of 2015 defines the term. The Tax Procedures Act of 2015 defines the term tax avoidance. So it's the same thing as tax planning. The Tax Procedures Act of 2015 defines the term tax avoidance. Defines the term tax avoidance. Defines the term tax avoidance as a transaction. Defines the term tax avoidance. So is that we should be quoting. Tax avoidance as, you open quote and say, as a transaction or a scheme. As a transaction or a scheme designed. As a transaction or a scheme designed to avoid liability. As a transaction or a scheme designed to avoid liability, to pay tax. As a transaction or a scheme designed to avoid liability to pay tax under any tax law. Under any tax law. Under any tax law. We can also add and say it is also the arrangement. It is also the arrangement of the affairs. It is also the arrangement of the affairs of a person. It is also the arrangement of the affairs of a person of business in such a way. It is also the arrangement of the affairs of a business or person in such a way as to avoid. In such a way as to avoid liability to pay tax. In such a way as to avoid liability to pay tax without contravening liability to pay tax, without contravening any tax legislation, without contravening any tax legislation or regulation. So that can be our attempt at Roman 1, the meaning of tax planning for 2 months. Then Roman 2 says, outline 4 reasons why enterprises engage in tax planning. Why do enterprises engage in this activity in tax planning? So for Roman 2, we say enterprises engage in tax planning for the following reasons. Enterprises engage in tax planning for the following reasons. enterprises engage in tax planning for the following reasons. The first bullet, to ease tax administration, in terms of methods. To ease tax administration in terms of methods used. To ease tax administration in terms of methods used in accounting for tax. To ease tax administration in terms of methods used in accounting for tax, comma, the records to be maintained. The records to be maintained, and the reports to be prepared. To ease tax administration in terms of methods used in accounting for tax, records to be maintained, and the tax reports to be prepared. The next bullet, to achieve the highest level of compliance, with tax regulations, So compliance means you're in compliance such that there's no risk of business interruption by the Revenue Authority. There's no risk of penalties. There's no risk of interest. There's no risk of prosecution by the Revenue Authority. So compliance means you keep the business safe from being interrupted and procedurally by the Revenue Authority, or the business being subjected to penalties and interest, or the business being closed down to the extreme. The next reason for engaging in tax planning, to reduce the impact of the tax burden. To reduce the impact of the tax burden, to reduce the impact of the tax burden, to reduce the impact of the tax burden. So you can reduce the impact of the tax burden by deferring recognizing of certain incomes so that you can pay tax later. For example, you can defer the tax burden of dividends by simply declaring bonus shares instead of paying cash dividends. Then that way, the shareholders don't have to pay withholding tax. Or if the company provides share ownership savings plans to employees. In other words, the company gives shares to employees like Safaricom does, or Equity Bank. You can defer, say the time, say an employee will take up the offer. So the time of recognition of shares probably will come 3 years later, so that the taxes on the share ownership is deferred. You reduce the impact of a tax through planning so that its impact is deferred to another period, the tax burden. Another reason for engaging in tax planning is to defer the impact of direct and indirect taxes, which you've already explained. To defer the impact of direct and indirect taxes, to defer the impact of direct or indirect taxes, to defer the impact of direct or indirect taxes. So that is December 2014, the A part. So I will let you attempt December 2014 B part as an assignment. BD Enterprises, this is a partnership with Admission, as there is S Baraka, P Dina. They will later on admit a partner called Ominde. So there's Admission, I think, March, later on, I think in the month of April or something. So you have to prepare two statements. The examiner tells you in the requirement. The first statement would be the statement of adjusted partnership profit or loss, as we discussed earlier. The second statement, you'll prepare a distribution schedule. Since the expenses and incomes accrue evenly throughout the year, the adjustment will not be in the income statement. The adjustment for Admission of Ominde would be only in the distribution schedule, because the expenses, the revenues and expenses accrue equally throughout the year. So please attempt that, then we'll be able to proceed from that point. Our next subtopic in our discussion will be conversion of a partnership into a limited company. In the next class, we'll be talking about conversion of a partnership into a limited liability company. This is called LLC. So our discussion in the next class will be based on conversion of a company into a partnership into a limited liability company. So until the next class, please enjoy the rest of your weekend and see you in the next class. So thank you very much. Asanteni sana. Have a blessed